The credit system has a strange way of punishing people who believe they are doing everything right. That is what makes it so dangerous. You can use a credit card responsibly, you can spend only what you can afford, you can keep the money in your bank account, you can wait for the bill, you can pay the full balance on time, you can pay no interest, you can pay no late fees, you can do exactly what most people were taught to do. Then 3 days later, your phone tells you your credit score dropped 20 points. Most people experience that as confusion. They think something broke. They think maybe there was fraud. They think maybe a late payment appeared by mistake. They think the system is irrational. But the system is not broken. It is doing exactly what it was designed to do. The problem is that most people do not understand the day that controls the system. They think the due date is the important day. It is important, but it is not the day that controls what the credit bureaus see. The day that controls the picture is usually the statement closing date. That is the hidden day. And until you understand that day, you can keep doing the responsible thing and still look irresponsible to the scoring model. This is the first principle. Credit scores do not measure your character. They measure data snapshots. And if the snapshot is taken on the wrong day, the system can misunderstand you. Imagine you have a credit card with a $5,000 limit over the month. You spend $2,000 groceries, gas subscriptions, maybe a few normal bills. You have the cash. You are not borrowing because you are desperate. You are using the card for convenience, points, protection, or habit. Then the bill arrives. You pay it in full, no interest, no late fee, no problem. At least that is what it feels like. But the credit bureaus may not see the zero balance after you paid. They may see the $2,000 balance before you paid. And once that number is reported, it can sit on your credit report for the month, so your bank account says responsible. Your credit report says high utilization. That gap is the problem. Most people think credit bureaus watch their accounts in real time. They do not. Experian, TransUnion, and Equifax are not watching every purchase and every payment as they happen. They usually receive periodic reports from your credit card issuer. In many cases, your issuer sends the balance from your statement when the billing cycle closes. That reported balance becomes the number the scoring model uses. So the question is not only whether you paid, the question is what balance existed when the picture was taken. This is the camera analogy. Your credit card issuer takes a picture once a month. If the picture is taken after you spent $2,000 and before you paid the bill, you look like someone using 40% of a $5,000 limit. If the picture is taken after you paid it down to $100, you look like someone using 2% of the limit. Same person, same spending, same income, same payment behavior, different picture, different score. This is why responsible borrowers get surprised. They pay by the due date, but the due date comes after the statement closing date. The bureaus already received the high balance. Your on-time payment protects you from late fees and interest. It protects your payment history, but it does not necessarily protect the utilization number that already got reported. The timing matters. Now, let us build the timeline clearly. Your billing cycle runs for about 30 days. During those 30 days, your balance rises and falls depending on spending and payments. At the end of the billing cycle, the statement closes. The bank creates your statement. The statement shows the balance on that closing date. That is often the number the bank reports to the credit bureaus. Then, about 3 weeks later, the payment due date arrives. If you pay by the due date, you are on time, but the credit bureaus may already have the statement balance. This is the trap. The due date keeps you from being late. The statement closing date often controls what gets reported. Those are different functions. A person can be perfectly on time and still report high utilization. That is why the system feels unfair. But once you understand it, you can control it. Now, why does this matter so much? Because your credit score is built from several categories, and utilization is one of the largest. Payment history is usually the largest category at about 35%. That makes sense. Lenders want to know whether you pay on time. But right behind it is amounts owed, often around 30% of the score. A major part of that category is credit utilization, which is the percentage of available revolving credit that shows as used. If your card has a $5,000 limit and the reported balance is $2,000, the utilization on that card is 40%. If the reported balance is $100, the utilization is 2%. That is a very different risk signal to the scoring model. The system treats high utilization as a warning sign because borrowers who are using a large portion of available credit may be closer to financial stress. That does not mean you are stressed. You may have the cash and simply plan to pay later, but the model does not see intention. It sees reported balance divided by credit limit. The model does not ask whether you are a responsible person. It asks how the numbers look on the snapshot. This is why utilization can move your score quickly. Under 30% is often treated as acceptable. Under 10% is usually better, but the highest score behavior often appears much lower than that. In the 1 to 6% range, that does not mean you must live like a machine forever. It means if you want the best score, especially before applying for a mortgage, auto loan, apartment, business credit, or new card, you need to control the reported utilization. Now, there is another important piece that many people miss. Utilization is not only measured across all your cards together. Individual card utilization can matter too. You may have $50,000 of total available credit across all cards, and your overall utilization may look low. But if one small card with a $600 limit reports a $590 balance, that single card looks maxed out. The scoring model can treat that as a warning sign even if every other card is low. That is why some people see strange score drops. They did not use much credit overall, but one card reported a high balance relative to its own limit. The system does not like maxed out individual cards. This matters because many people put a large purchase on a low limit card without thinking about the reporting date. A plane ticket, a hotel, a car repair, a medical bill, a home item. If that charge posts before the statement closes and the limit is low, the reported utilization can look dangerous for that card. Then the score drops. No missed payment. No interest, no financial crisis, just a bad snapshot. This is the second principle. The system does not only care what you owe, it cares how much you appear to owe relative to each limit on the day reported. That is why timing and limits matter. Now, the good news is that utilization is one of the fastest moving parts of the score. A late payment can damage your report for years. A collection can create long-lasting harm. A charge-off, bankruptcy, or serious negative mark can stay visible for a long time. Utilization is different. In many widely used scoring models, utilization has no long memory in the same way. The balance reported this month can be replaced by the balance reported next month. If your utilization is high this month and low next month, the score can respond quickly. There are newer scoring models that examine trended data over time, including whether your balances are rising or falling. But many lenders still use older versions where the current reported utilization matters heavily. That means you can improve the utilization picture quickly by controlling the next snapshot. This is the opportunity. It is not magic, it is not cheating, it is not exploiting anything illegal. It is simply understanding when the system measures you and making sure it measures the right thing. Now, the method is simple. Do not wait until the bill arrives. Pay before the bill is created. That sentence changes everything. If your statement closes on the 15th and your current balance on the 11th is $2,000 on a $5,000 limit, the credit system is about to see 40% utilization unless you act. So on the 11th, you log in and pay down the card manually. Suppose you pay $1,900 and leave $100. Then when the statement closes on the 15th, the statement balance is $100. That is the number the issuer reports. $100 on a $5,000 limit is 2% utilization. Then, when the due date comes later, you pay the remaining $100. You still pay in full, you still pay no interest, you still use the card, but the credit bureaus see a low balance instead of a high balance. That is the entire mechanism. You are not changing whether you paid. You are changing when you paid. Most people let the bank take the picture on the worst day of the month. A better system cleans up the balance before the picture is taken. That is the practical difference. Now, once people learn this, they often make the next mistake. They think if low utilization is good, zero utilization must be perfect. That seems logical, but credit scoring does not always reward zero across every card the way people expect. The scoring model wants to see that you can use credit and manage it responsibly. If every card reports zero every month, it may appear that you are not using revolving credit at all. That is not necessarily terrible, but it may not produce the highest possible score. People with very high credit scores often report a very small amount of utilization, not zero. The strategy is sometimes called all zero except one. The idea is simple. If you have multiple credit cards, pay all cards down to zero before their statement closing dates, except one card on that one card. Leave a tiny balance to report, something like $10, $20, or about 1% of that card's limit. Depending on the card and the situation, this does two things at the same time. It tells the scoring model you are using credit, and it tells the scoring model you are using almost none of your available credit. That combination can be very powerful. Active use, extremely low utilization. That is what the model likes to see. Now, this is not the same as carrying a balance. This distinction is critical. Carrying a balance means you do not pay the full statement balance by the due date and you begin paying interest. That is expensive and unnecessary. Reporting a small balance means the statement closes with a small amount showing. Then you pay that small amount by the due date. You still avoid interest, you still pay in full. You are only controlling what balance gets reported. Do not confuse reported balance with interest, bearing balance. Those are not the same. The goal is not to pay interest to build credit. That is a myth. You do not need to pay interest to build a strong credit score. You need to report controlled use and pay on time. Let us turn this into a system. The first step is to find the statement closing date on each credit card. Do not use the due date as a substitute. The due date is easy to find because banks display it clearly. The statement closing date is often less obvious. You may need to open a past statement. Look for language like billing cycle closing date, statement closing date, cycle end date, or next closing date. Write it down. Do this for every card. If you have 3 credit cards, you may have 3 different closing dates. One may close on the 7th, another on the 15th, another on the 28th. You need to know each one. Credit scores are built from reported data, and reported data often begins with these closing dates. If you do not know the dates, you are not controlling the system. The second step is to set reminders before the closing date, not on the closing date before it. A reminder 2 to 4 days before the closing date can work because payments may take time to post. If the card closes on the 15th, you may set a reminder on the 11th or 12th. That gives the payment time to clear before the statement is generated. This buffer matters. If you pay on the 14th and the payment posts on the 16th, you may miss the snapshot. The statement may close with a higher balance. Then you have to wait another month to fix it. A system needs a margin of safety. Do not make the payment timing too tight. The third step is to make a manual payment on the reminder day. Do not rely only on autopay for utilization control. Autopay is useful. It can protect you from late payments. It can pay your statement balance by the due date. It is a good safety net. But autopay usually operates after the statement closes. It is designed to pay the bill on time, not to control the reported balance. If you want the credit bureaus to see a low number, you need to act before the statement closes. So on reminder day, log in, check the current balance, decide what you want reported. Pay everything above that number. If using all 0 except 1, pay all cards to 0 except the selected card. On that selected card, leave a small balance. The fourth step is to pay the remaining small balance by the due date. This is non-negotiable. If you leave $20 to report, that $20 must still be paid by the due date. A missed payment on a small balance can damage your credit far more than high utilization. Payment history is still the largest scoring category. Do not risk it. This is where autopay can help. You can manually control the pre-closing balance, then let autopay pay the remaining statement balance by the due date, or you can pay it manually later. The method matters less than making sure it gets paid. The fifth step is to repeat the process every month. Credit scoring is a recurring system. Your process must be recurring too. Find closing date, set reminder, pay before closing, leave small balance on one card if appropriate, pay remaining balance by due date. Repeat, that is the system. Now, there is another warning. Do not confuse this strategy with credit cycling. Credit cycling happens when you repeatedly spend up to your credit limit, pay the card down mid-cycle, then spend up to the limit again within the same billing cycle. For example, if you have a $2,000 limit and you spend $2,000, pay it, spend $2,000 again, pay it again, and keep doing that. The bank may view it as suspicious. Banks may not like seeing a card used far beyond the monthly limit through repeated cycling. It can trigger account review, freezing, or closure. So this strategy should not become a way to force more spending through a small credit limit. If you constantly max out the card just to pay it down and use it again. The real issue may be that your limit is too low for your normal spending or that your spending needs to be controlled. If you pay in full every month and have strong income, you can consider requesting a credit limit increase. A higher limit can reduce utilization naturally. If you spend $2,000 on a $5,000 limit, that is 40%. If the limit becomes $10,000, the same spending is 20%. If the limit becomes $20,000, the same spending is 10%. The spending did not change, the utilization changed because the denominator changed. That is the simple math. But requesting a credit limit increase should be done thoughtfully. Some issuers may use a hard inquiry, some may not. Your income, payment history, credit profile, and account age can matter. Do not ask recklessly if you are about to apply for a mortgage or major loan and cannot afford an inquiry. Ask the issuer how the request will be handled. Again, understand the mechanism, do not blindly act. Now, let's talk about why this system is so effective before major credit applications. If you are applying for a mortgage, auto loan, apartment lease, business financing, or premium credit card, a difference of 20 or 40 credit score points can matter. It can affect approval, interest rates, insurance costs, in some situations, deposits, and access to better terms. Utilization optimization can be one of the fastest ways to improve the score before an application, if there are no deeper negative marks. That is why timing is important. If you are applying for a mortgage in 60 days, do not let high balances report. Now control the statement closings for all cards, get utilization low, avoid new debt, avoid new inquiries unless necessary. Do not close old accounts, do not make major changes without understanding consequences. In that context, the statement closing date becomes a strategic date, not a minor administrative detail. Now, if your score is already in the high 700s or 800s, this strategy may fine-tune the score. It may help optimize it. It may prevent unnecessary dips. If your score is in the 500s or 600s, utilization may still matter, but it may not be the only problem. You may also have late payments, collections, charge-offs, high debt, thin credit history, inaccurate information, or other negative marks. Utilization can move quickly, but it cannot erase a serious payment history problem. This is another important distinction. Do not think one utilization strategy fixes every credit problem. It fixes the snapshot problem. If the report has deeper problems, those must be addressed separately. But even then, controlling utilization still helps because it removes one source of damage from the score. A good credit strategy handles both. Clean the report where it is wrong. Pay on time, control utilization, keep accounts healthy, build length of history, avoid unnecessary inquiries. Maintain a mix of credit responsibly, that is the full system. The source focuses on utilization because utilization is highly controllable. That is why it is powerful. Now, let us understand the score categories more broadly. Payment history is the biggest part. Pay on time. Always. No strategy matters if you miss payments. A single missed payment can damage the score for years. The small balance you leave for reporting must still be paid. A credit score strategy should never create late payment risk. Amounts owed, especially utilization, is the next major part. This is where the statement closing date strategy operates. Length of credit history matters. Older accounts help. Closing old accounts can sometimes reduce available credit and shorten history depending on the model. Be careful. Before closing cards, credit mix matters. Having experience with different types of credit can help, but do not take unnecessary debt just to improve mix. New credit matters. Too many inquiries or new accounts in a short period can hurt. The utilization strategy mainly helps one large category. It does not replace the others. Now, why does paying on time still sometimes hurt the score? It does not hurt in the payment history category. Paying on time helps or protects that category. The problem is that paying after the statement closes may allow high utilization to report before the payment is made, so you can get full credit for paying on time and still lose points from utilization. This is what confuses people. They think responsible behavior should produce one result across the whole score. But the score is built from different variables. You can do well in one variable and poorly in another at the same time. On-time payment, good. High reported utilization, bad. Both can be true in the same month. Once you understand that, the score becomes less mysterious. Now, let us use a concrete example. A card has a $5,000 limit. You spend $2,000 during the cycle. If the statement closes at $2,000, utilization is 40%. The scoring model sees elevated risk. Even if you pay the full $2,000 by the due date, the reported number for that month may already be 40%. Now suppose you pay down $1,900 before the statement closes. The statement closes at $100. Utilization is 2%. The bureaus see low usage. You pay the $100 by the due date, no interest, no late fees. The difference is not spending behavior, it is reporting behavior. This is why I think of the system as controlling the photograph. If you know the camera clicks on the 15th, do not stand in front of the camera with a messy balance on the 15th. Clean it up on the 11th. Now why leave 1%? Because 0 on all cards can sometimes be less optimal than tiny use. The scoring model wants evidence that you use credit and manage it well. A tiny reported balance shows activity without risk, but the tiny balance should be tiny, not 10%. If you are trying to optimize, not 30%, not a balance that creates interest. A small amount. The exact number does not need to be perfect. $10 to $20 may be enough on one card depending on the limit and issuer. The idea is not to obsess over pennies. The idea is to avoid all cards reporting 0 while also keeping total and individual utilization extremely low. For many people, the all 0 except one method is the cleanest approach. All cards report 0. One card reports a very small balance. Then that balance gets paid by the due date. That is the high score behavior pattern. Now, if you have only one card, the method is simpler. You can leave a small balance on that card before the statement closes, then pay it after the statement and before the due date. Do not let it become a large balance. Do not miss the due date. If you have multiple cards, choose one card to report the small balance. Preferably use a card with no annual fee, good standing, and a limit high enough that a tiny balance creates very low utilization. If one card has a low limit, be careful not to let it report high utilization. Low-limit cards can hurt scores quickly when used casually. Now, let's talk about real life. People do not always spend evenly. Some months have large purchases: travel, medical bills, car repairs, insurance premiums, school costs, home repairs. If a large purchase must go on a card, you may need to make a payment immediately or before the statement closes to keep utilization low. Do not wait for the bill. The large purchase may be paid in full later, but the credit system may still report it first. If you are planning a big purchase and care about your score, think about the closing date before the purchase. If the card closes tomorrow, a large charge today may report almost immediately. If the card just closed, you may have more time to pay it down before the next snapshot. The timing of spending can matter. That does not mean you must live in fear of your cards. It means before important credit applications, be strategic. Now, there is a second way to reduce utilization: increase available credit. If you keep the same spending but increase limits, utilization falls. This is why credit limit increases can help, but they should not become permission to spend more. If a higher limit causes higher spending, the benefit disappears and the risk increases. A higher credit limit is useful only if behavior remains controlled. The limit increase gives space. It should not create appetite. This is a principle in all debt management. Access to credit is not wealth. Credit is a tool. Used well, it improves flexibility and score. Used poorly, it becomes a trap. Now, let us consider the credit bureaus themselves. Experian, TransUnion, and Equifax receive data from lenders. Not every lender reports on exactly the same date. Not every account updates instantly. Some issuers report statement balance. Some may report at other times. The general strategy still works. But you should verify your own cards if you want precision. Check your credit report and see when balances update. Compare the reported balance with the statement balance over time. You can learn each issuer's pattern. Again, systems thinking. Do not assume when you can verify. Now, there is also the difference between VantageScore and FICO. Many free apps show VantageScore or educational scores. Lenders often use FICO scores, and different versions exist for credit cards, auto loans, mortgages, and other purposes. A change in one app may not perfectly match the score a lender uses, but utilization generally matters across scoring models, so the strategy remains useful even if the exact point movement varies. Do not obsess over one app's daily movement. Focus on the underlying behavior. Low reported utilization, on-time payments, clean report. Long history, responsible credit use. That is what matters. Now, the source mentions a near-perfect score. I would be careful with that. A perfect 850 is not necessary for most financial goals. Once your score is high enough, the difference between excellent and perfect may not change the terms you receive. A person with a 780 or 800 may already qualify for the best rates in many cases. So do not turn credit scoring into an identity game. The goal is not vanity. The goal is better options. Lower borrowing costs, better approvals, more flexibility, less stress. If optimization helps you get there, use it. But do not obsess over every point if you already have excellent credit and no major application coming. Credit is a tool, not a measure of your worth. Now, why does this system feel like a loophole? Because most people were told to pay by the due date. That advice is incomplete. It is not wrong, but it is incomplete. Paying by the due date protects payment history. Paying before the statement closing date controls utilization. You need both. The banks emphasize due dates because late payments create fees, interest, and risk. They are not necessarily focused on teaching you how to optimize reported balances. That is your responsibility. Again, the system gives you the rules, but not always the strategy. The person who knows the timing looks much better than the person who only knows the due date. Same underlying borrower, different reported data. This is why knowledge matters. Now let us discuss interest. Many people still believe carrying a balance helps build credit. That is false and costly. You do not need to pay interest to have a strong score. You can use the card, let a small balance report, and then pay it in full by the due date. The score sees usage, the bank gets paid, you avoid interest. Interest is not the price of good credit. Discipline is paying interest on credit card balances can be extremely expensive and can create a debt spiral. If you ever cannot pay the full balance, Stop optimizing score points and focus on debt elimination. Paying 20% interest is far more damaging than a temporary utilization issue. Credit score optimization is for people who can pay in full. If you cannot pay in full, the priority is financial stability. Now let us create a weekly practical flow. At the beginning of the month, know which cards close and when. A few days before each closing date, check balances, pay cards down. Leave a tiny balance on one chosen card if using all zero except one. After statements close, verify the statement balance before the due date. Pay remaining statement balances in full. Review your credit report periodically to confirm balances are reporting as expected. Request credit limit increases strategically when appropriate. Avoid credit cycling. Repeat. This is not complicated once set up. The difficult part is that most people are never told the closing date matters. Now, let us talk about people who are afraid to use credit cards. Some people avoid cards because their score drops after large purchases. The lesson is not necessarily to stop using cards. The lesson is to control reporting. If you can pay in full and avoid interest, credit cards can provide protection, rewards, convenience, and credit history. But if the reported balance is high, your score can suffer temporarily. Use the card, control the snapshot, pay in full. That is the balanced approach if you are prone to overspending. The answer may be different. A credit score is not worth consumer debt. If credit cards create spending problems, use them more carefully or not at all. Financial behavior comes before score optimization. Again, the tool must match the person. Now, the individual card utilization rule deserves more emphasis. Suppose you have 3 cards. Card A has a $20,000 limit and reports 0. Card B has a $20,000 limit and reports 0. Card C has a $600 limit and reports $500. Your total available credit is $40,600. Your total reported balance is only $500. Overall utilization is low, but card C is over 80% utilized. The scoring model may see that as risky, so you need to manage both levels. Overall utilization, individual card utilization. This is why low-limit cards require special attention. If you must use a low-limit card, pay it down before statement closing. Do not let it report near maxed out. Now, what if all cards report 0 and your score drops slightly? That can happen. The model may penalize lack of recent revolving activity. The all 0 except one strategy solves it. Leave one tiny balance on one card. Not on every card, just one. This is a subtle point, but it matters for optimization. 0 debt is emotionally appealing. Tiny reported use may be better for the score. The financial reality is the same if you pay in full, but the reported data is different. Now, let us consider timing with multiple cards. If each card has a different closing date, you may need multiple reminders. Do not try to remember manually. Use a calendar, use recurring phone reminders, use a spreadsheet, use the bank app, build the system so it does not depend on memory. Memory fails, systems work, set a reminder 2 or 3 days before each closing date, make the pre-closing payment. Then let AutoPay handle the final statement balance by due date if you trust it and verify it. AutoPay should be a backup, not your utilization strategy. This is a good mental model. Manual pre-closing payment controls the report. AutoPay protects against lateness. Use both if appropriate. Now, credit limit increases can reduce the need for constant micromanagement. If your normal monthly spending is $2,000 and your limit is only $5,000, utilization can easily look high if your limit becomes $15,000. The same spending is much easier to manage. This does not mean you should borrow more. It means the reported percentage becomes lower. When asking for a credit limit increase, emphasize that you pay in full, use the card for regular expenses, and want more room to keep utilization low. Some issuers allow online requests, some allow soft pull increases, some require income updates. Be honest. Do not inflate income. Do not request more credit to spend more. The purpose is utilization control. Now, let us discuss errors and negative marks. If your score remains low despite low utilization and on-time payments, inspect the full credit report. There may be inaccurate collections, outdated information, accounts that do not belong to you, late payments reported incorrectly, charge-offs, or other issues. You are entitled to review your credit reports. If information is inaccurate, you can dispute it through the proper process. Keep records. Be specific. Provide evidence where possible. But do not confuse legitimate negative marks with inaccurate ones. If the information is accurate, the strategy becomes rebuilding over time, on-time payments, low utilization, responsible account management, and patience. Utilization is fast. Payment history takes time. This is why prevention matters. Never miss a payment. not on $10. Not on a card you forgot about, not on a store card you rarely use. One small missed payment can cost far more than any utilization trick can fix quickly. Now, what if a statement closing date changes? It can happen. Issuers may change cycles. You may request a due date change, which can affect the closing date. Always verify after changes. If you change the due date to align with paychecks, check the new statement closing date and update reminders. Do not assume old reminders remain accurate forever. Credit optimization requires maintenance, not obsession maintenance. Now, let us talk about utilization and interest during grace periods. If you pay your statement balance in full by the due date, you generally avoid interest on purchases because of the grace period. If you carry a balance from month to month, the grace period may be lost and interest may accrue differently. This can make the strategy more complicated, so the cleanest version assumes you pay in full every month. If you are already carrying credit card debt, focus first on paying it down. The utilization strategy can still help as balances fall, but the bigger problem is interest expense. Credit card interest can destroy wealth quickly. Do not manage optics while ignoring the fire. Put out the fire first. Now, there is a broader lesson here. Many financial systems operate on reporting dates, not reality. Credit scores are not the only example taxes. Bank statements, financial aid forms, loan underwriting, and investment reporting often depend on snapshot dates. The person who understands the measurement date can present a more accurate and favorable picture. The person who ignores it may be judged by a distorted snapshot. This does not mean lying, it means timing. If the system measures you on a certain day, make sure the data on that day reflects your true financial discipline. That is rational. Now, why do banks not emphasize this? The bank wants you to pay on time. That protects the bank from default risk. The bank may not care whether your utilization reports at 40% or 2% as long as you pay. In some cases, banks benefit from balances, interest, and customer dependence. They are not necessarily incentivized to teach score optimization. The credit bureau wants data. The scoring model uses data. The consumer has to learn the timing. That is the system. If you do not know the rules, you become the product of the rules. If you know the rules, you can operate inside them intelligently. Now, I want to be careful with the phrase banks do not want you to know. It can sound conspiratorial. I would phrase it more precisely. The system is not designed around teaching you how to look best to the scoring model. It is designed around collecting and reporting data. The information is available, but it is not always explained clearly. That lack of clarity creates an advantage for people who understand it. You do not need a conspiracy. You need a mechanism. The mechanism is enough. Now let us review the exact execution. Find the statement closing date for every card. Set a recurring reminder 2 to 4 days before each closing date. On the reminder day, pay down the balance before the statement closes. If using multiple cards, pay all to zero except one. On one card, leave a tiny balance around 1% or a small dollar amount. Let the statement close. After the statement generates, pay the remaining small balance by the due date. Never miss a payment. Avoid credit cycling. Request higher limits if normal spending makes utilization hard to manage. Monitor the credit report to confirm reporting. This is the full system. Now, what should someone expect after doing this? If utilization was the main issue, the score can improve quickly after the next reporting cycle. Sometimes it may take a few weeks for the bureaus and apps to update. The point movement depends on the rest of the credit profile. Someone with a clean file and high utilization may see a meaningful jump. Someone with serious negative marks may see less movement, but the direction should generally improve when utilization falls. Again, no guaranteed point number. Credit scoring is complex, but the mechanism is strong. Now let's think about the person preparing for a mortgage. This is where the stakes are high. A higher credit score can affect mortgage interest rates and loan approval. A small difference in rate can cost or save thousands of dollars over time. Before applying, you want reported balances optimized. That means controlling statement closings for at least 1 or 2 cycles before the lender pulls credit. Do not make large card purchases right before a mortgage pull unless you pay them down before reporting. Do not assume paying by the due date is enough. Do not open or close accounts without advice. Do not run up balances even temporarily if the statement is about to close. The mortgage lender sees the report. The report sees the snapshot. Control the snapshot. Now, for auto loans, credit cards, and personal loans. The same logic applies. If you know an application is coming, prepare the report before the application. Utilization is one of the fastest levers available. This is not manipulation. It is financial hygiene. You brush your teeth before a photo. You pay down balances before the credit snapshot. Same idea. Now, I want to address people who use one card for rewards. Rewards can be useful, but do not let rewards create high reported utilization. Earning 2% cash back is not worth dropping your score before a major application. If you are using a rewards card heavily, consider paying it several times during the month or before statement closing. Also consider a credit limit increase if spending is normal and paid in full. Rewards should be a bonus. They should not damage the broader financial system. Now, another point, business expenses on personal cards. Some people put reimbursable work expenses or business expenses on personal credit cards to earn rewards. If the statement closes before reimbursement or payment, utilization can spike. This can harm personal credit even if the spending is not truly personal. If you do this, you must manage reporting carefully or consider business credit products that do not report the same way to personal credit, depending on the issuer and structure. Again, the report does not know your story. It knows the number. Now, what if a card issuer reports a mid-cycle balance instead of statement balance? Some issuers may report at different times or update when requested. This is why reviewing your credit report is useful. But for many major issuers, statement balance is the key number. If your issuer behaves differently, adjust the strategy based on actual reporting behavior. The principle remains: control what gets reported, do not assume, verify. Now, let us return to the deeper philosophical point. Financial systems reward people who understand timing. The same action can produce different results depending on when it happens. Paying the credit card after the statement closes protects you from interest and late fees. Paying before the statement closes protects your utilization. Both payments may use the same dollars. The difference is timing. Most people do the right action at the wrong time and then blame themselves when the score drops. The better response is to learn the system. Do not get emotional. Do not assume the system hates you. Do not assume your score is mysterious. Break it into causes and effects, because high balance exists on statement closing date effect. High utilization reports, because high utilization is about 30% of scoring effect. Score may drop, cause balance is paid down before closing date effect. Low utilization reports cause small balance reports on one card and all others. Zero effect model sees active use with very low risk, cause remaining balance is paid by due date effect. No interest and no late payment. That is the machine. Once you see the machine, the solution is obvious. Now, the credit score should not become your master. A credit score is useful because it affects borrowing terms, but the purpose of financial life is not to worship a score. The purpose is to build stability, optionality, and wealth. Credit is one tool. A high score can lower costs and create opportunities. But if chasing points causes overspending, anxiety, or unnecessary complexity, you are missing the point. The healthiest approach is simple. Use credit only for what you can afford. Pay in full, control the statement balance. Keep old accounts healthy where appropriate. Avoid unnecessary debt. Monitor reports for errors. Do not pay interest to build credit. Do not miss payments. That is enough for most people. Now, the final principle is this. The credit system does not grade you on what you meant to do. It grades you on what gets reported. If the bank reports a high balance, the scoring model reacts to a high balance. If the bank reports a low balance, the model reacts to a low balance. The model does not know whether the high balance was temporary, whether the money was sitting in your checking account, whether you plan to pay tomorrow, or whether you always pay in full. It sees the snapshot. So take control of the snapshot. That is the whole strategy. Find the closing date, pay before the statement closes. Leave a tiny balance on one card if you want optimal reporting. Pay the rest by the due date. Avoid credit cycling. Ask for higher limits when appropriate. Repeat. And remember that the goal is not to trick anyone. The goal is to make sure the system sees the truth. You are not a high-risk borrower simply because the bank took the picture before you paid. You are a responsible borrower who needs to control the camera. Once you do, the same habits that used to make your score drop can begin working in your favor. That is the difference between being managed by the credit system and managing the credit system yourself.